Thank you so much for joining us today for our 2024 Ground Plus Insurance webinar. Before we begin, I have just a couple housekeeping items to go over. Today's webinar is eligible for 1 CPE credit. In order to receive that credit, you must be active for the full duration of the webinar and answer at least 3 out of the 4 poll questions that will appear on your screen throughout our presentation. Each poll question will only be up on your screen for about 30 seconds. While the poll question is up, you won't be able to see the PowerPoints, but as soon as we close that poll question, the slides will come back up. If you have any issues submitting an answer to a polling question, please just send me a chat using the chat box. My name is Kayla Juba, and just let me know as soon as possible with what your answer was so I can count that for CPE. Everyone is muted, so please use that chat box to submit questions as you have them. You can download the PowerPoint slides through the GoToWebinar panel on your screen under the Handouts section. Please know that we will also be sending out the slides as well as a recording of today's webinar on a page on our website at the end of the week. So thanks again for joining us. Now I'll turn things over to Scott Esworthy to introduce our presenters and our agenda today.
Okay. All right. Thank you, Kayla. And Kayla is going to be driving the slide today, the presentation. First of all, thanks everyone for joining us this afternoon, and hopefully your holidays are going well. We only got so many people have asked me today, am I prepared for Christmas? I have not bought one gift yet, so I guess that sort of says where I am. So anyway, joining me today is Matt Harvey, tax senior manager. He's located in Wisconsin, works remotely, comes into the Pennsylvania area quite a bit to meet with us and clients. And likewise is Ryan Perez, a longtime audit manager in our practice and works with probably a lot of clients on this call today, on this webinar. All right, the agenda. As we go into this, we got the adoptions to statutory SSAPs. I'm going to cover that, and then and just to mention, nothing really earth-shattering there. I mean, it's pretty minor items, really. The biggie is the principles-based bond project. Ryan Perez is going to cover that. That will probably be about half of the presentation, really. And then I'll come back, cover some updates on the blanks, and then we're going to jump at that point to the tax update. Matt is going to cover that, talk about a couple of SSAPs related to taxes, and then likewise talk with the election results, talk about what can be expected and so forth, what's out there now, what they're thinking might happen related to corporate taxes and so forth. All right, Kayla, next slide. All right, the sources of this presentation. This is, if you've attended our presentations the last couple of years, we're doing it the same way. We have the links here. So basically the core information that we use to put this together, especially for the SSAPs, is basically, we have it here for you. So these are live links. You can actually click on these links and go right to the NAIC sources of where we got our information from. So if you're like me, a day like today, you're just maybe scratching down some notes of something that might apply to your company. But then later, if you need to do a deep dive, use these links that we've attached. All right, Caleb. All right, this is a one of these QR code deals. You could take a picture of it, and it goes to an NAIC free self-session, a self-learning deal related to the bond project. So if you want to get some extra training related to the bond project, which would affect your first quarters in 25, here's some free training. I think it's free until the end of the year, and then I think the NAIC is going to start charging for it beginning 25. All right, adoptions to statutory accounting. So this is where we're going to get going here. So this first item, collateral loan reporting, you see this primarily with life companies. I've worked in P&C side for a long time, really very rarely ever seen anything on this topic. So from what I've gathered in some research, it's primarily a life topic. related to, this is all about the admissibility of these collateral loans and what type of collateral is actually supporting them, and is it admissible? So I guess in the past, no one had really looked at the actual types of collateral that was collateralizing these collateral loans. So that's what this 21R is all about, and the changes there. Kayla, we can go to the next couple slides. There we go. Yeah, and this likewise, this relates to the same topic, just giving some more detail about it. And likewise, going into the last bullet there, talks about there's even audited financials that might be required for certain types of collateral to admit these collateral loans. Next item, next page, there we go. And then likewise, here's a schedule that sort of lists out, and this is how the collateral loan would be reported based upon its underlying collateral and the types of the collateral type, which you can see here on this schedule. All right, investments in subsidiary SCAs, basically. This one has been around. It was actually adopted effective back in March of this year, but it's an item that we run into with some large groups. And so basically, this is just clarification. It's nothing new. It's just clarification of the SSAPs, because there's a lot of confusion. It's sort of tricky wording, the way they worded the SSAPs in the past. So that last bullet, so basically it's talking about admitting audited investments in entities owned by an unaudited downstream non-insurance holding company, SCA entity is permitted. So I think there was confusion if those investors' underlying investments of a non-audited entity would be allowed to be admitted or not, and they are. So that's what reference 202330 is all about, just clarifying that for the users. All right. Okay. We go into, oh, this one's very minor. Let's see, one second here. Okay, yeah, this one is simply the Affordable Care Act, simply just removing disclosures. There's no disclosures were needed related to ACA anymore. That's what this is all about. So very minor. Next item there, Kayla. Okay, yeah, this is one I thought we were going to. So at the summer meeting, this one is sort of interesting, and I always curious about what the circumstances is, or the client or the company that probably created this to come about. But basically, this is talking about reinsurance within a group. So intercompany reinsurance pooling arrangement. So what this is about is there was inconsistencies actually in the SSAPs and interpretations about when you're transferring assets and liabilities and so forth, what value to use. So I guess there was inconsistencies between interpretation 03-02 and SSAP number 25 related to this item. Okay, so we can go to the next page. Okay, so basically, at the end of the day, again, this is referring to the interpretation 03-02 and 25. 03-02 related to stat book value, when you're valuing and reporting the transactions within a reinsurance agreement between the parties, intercompany. Then SSA 25 referred to using statutory value. So you can assume what the conclusion was. So let's go to the next slide there. Right. So the conclusion is basically it all should be valued on the stat value. So therefore, stat book value is what transactions within a group related to intercompany reinsurance should be valued on. Okay, as we go to the next slide. Okay, going into disclosure. Oh, so here we go with this. This one's all about disclosure. So there's no accounting change or anything. It's just talking about additional disclosure. And this one actually it's minor, but it would relate to probably the majority of the companies on this webinar. There's disclosures now that are required about the amounts and terms of unused lines of credit. I know a lot of my clients have lines of credit with a local bank, but very rarely is it ever used. So many times unused balance. So now there's disclosure required, and this is effective, actually it was effective in August. So it's disclosure now required related to these unused lines of credit. And other commitments as well, but that's probably the main item that would impact most, especially most of the smaller mutual companies in the region. Okay, derivatives. Okay, this is more about disclosure. Let's talk about, there's now related to changes with disclosing the cash flow accounting policy, and then likewise the accrued interest on related to the derivatives from repos, securities borrowing, separate disclosure of significant reverse repos and counterparty disclosures of significant repos and reverse repos. So basically, if you have any of those types of instruments, definitely look, there's more disclosure required now. Okay. All right, we got common control arrangements here. Now, this gets into with leases. You know, as you know, the main lease gap accounting that's out there, that's been rejected by the SSAPs. Although there is, when it comes to leasehold improvements, what this is about, again, so it goes back to that comment before I said about, I wonder what brought this about. So if you have leases among entities within the same controlled group, basically whatever is determined as the life of this leasehold improvement within your group, that's the max it can be amortized over. And it's calling out if you have leases that other parties outside of the company, if they're part of this as well, certain situations don't allow you to then amortize it longer. So basically, if you have a lease within parties within the group among companies, whatever is the life determined of that leasehold improvement within the group, that's the max it can be amortized over. Okay, next one, crypto assets. In short, the regulators are not a big fan of crypto. I'm not either, but you know, I'm sort of an old guy. So, but basically, they're not admitted. So if you do have a standalone crypto asset on your books, it will be not admitted. But what's interesting, and it's the second to the last bullet, if you have indirectly held crypto assets, and what I imagine that to be is, let's say, just to make an example, you have some sort of mutual fund or something that within the mutual fund that is holding crypto assets, then the mutual fund, the investment is admitted like any other mutual fund. But if you're holding standalone crypto assets, they are not considered non-admitted. All right, next one. Oh, this one's really exhilarating. They're removing the R's from the guidance. You're no longer going to have revised and R as identifiers. Okay, let's move on. Okay, some more. This one simply is just, it was certain types of guidance related to, let's see, what was the case here? Different FASB concepts, obviously, are not allowed and rejected as part of statutory accounting. Next one, cash and cash equivalents draft, short term. This one is interesting. At the beginning of the year, there's just more guidance out there restricting what is permitted to be considered cash equivalent, short term. So if you go to the next slide, Kayla, I think it gives a list. So it talks about the very beginning, again, this is effective 1/1/25, CDs with a maturity of less than 12 months at the time of the acquisition are reported as cash. Regardless of the maturity, the following investments are not permitted to be reported as cash equivalents and shall be reported on the investments schedule below. So basically, any of the items below on this slide are not allowed to be considered cash and cash equivalents. To me, it's pretty obvious. I'm not sure why someone would try to report them as cash and cash equivalents or short-term investments, but that's the list. Next page. All right, I think this one I'm going to hand it over to Matt Harvey, our tax expert. He's going to handle a couple of these SSAPs that relate to taxes. So Matt.
Great, thanks, Scott. As Scott mentioned, essentially there are two changes to statutory accounting in the tax space, which I'll be discussing. The first one relating to SAP number 93. So during the 2024 Spring National Meeting, the Statutory Accounting Principles Working Group adopted agenda item 2022-14, dealing with new market tax credits, which revised SAP number 93, the low-income housing tax credit property investments. Essentially, this expanded and amended guidance to include all tax credit investments, regardless of structure and type of state or federal tax credit program. As a reminder, to encourage investors to invest in programs that help low-income housing communities, Congress established a new market tax credit program back in December of 2000 that allowed individuals and corporate taxpayers to receive a non-refundable credit. Currently, the existing statutory guidance does not encompass federal new market tax credits or other federal tax credit investments for that matter. SAP number 93 is limited to just low-income housing tax credits. Effectively, the purpose of the revisions are to expand the scope to include federal and state credit programs and investment structures, offer additional guidance on accounting, recognition, and reporting of tax credit investment structures, including a prospective utilization assessment, which we'll get into very shortly. Effectively, you must perform in certain circumstances this assessment to determine the admissibility of the tax credit investments. As of January 1st, 2025, reporting entities will prospectively modify the recognition, accounting, and reporting of the tax credit investment structures. And then all tax credit investment structures that fall within the scope of 93, not currently reported on Schedule BA, will be transferred to Schedule BA as of that January 1st, 2025 date. We can go to the next slide. More substantial revisions were made to SAP number 93 in response to concerns raised by interested parties over the administrative burden of paragraph 18 of the admittance test. So that's now referred to the prospective utilization assessment. Again, the prospective utilization assessment was revised to remove the initial assessment of the current portion of unallocated tax credits and then replaced with language that required companies to perform the assessment only if certain conditions exist. So effectively, you just need to perform the assessment if the reporting entity records a valuation allowance or if the reporting entity becomes aware of other facts or circumstances that indicate that you'll not be able to utilize the unallocated tax credit. We can go to the next slide. The last major tax revision was to SAP number 94R. Previously, SAP 94R was limited to transferable and non-transferable state tax credits. The overall purpose of the revision was to expand the scope to include all federal and state purchased tax credits. Again, SAP number 93 deals more with tax credits earned from investments, whereas SAP 94R is related to simply purchasing the credit itself. There are some additional revisions to SAP 94R, which eliminated the off-balance sheet requirement. There is some clarification that awarded tax credits are not within the scope of 94R. And then there are some additional disclosures that were added regarding commitment and contingencies. Again, changes for this will be prospectively effective January 1st, 2025. So the good news is if you have these tax credit investments or purchase state or federal transferable tax credits, we now have more accounting guidance on how to properly treat these items if they fall outside the scope of low-income housing tax credits. If you don't have these investments or purchase federal or state tax credits, then you don't really need to worry about these changes. So I think with that being said, we can go to the next slide, and I believe I'm turning that back over to you, Scott.
Yeah, very good. All right, thanks. Thanks, Matt. All right, so this one's getting into residuals. So basically incorporate clarifying edits for residuals in order for all SSAPs to refer to SSAP 21. So it's just cleaning up language within the SSAPs. The next item, 2024-09, it's the same type of item. It's just cleaning up the language and the references related to cash and short term related to the other changes we just discussed on a slide. Next slide, Kayla. All right, let's see, adopted at the fall meeting, effective 1/1/25. Again, there's more, it's more cleanup. So cleanup related to the new market tax credits, related to what Matt was just referring to, related to SSAP 93 and 94. And then lastly there on the page, which is a good guy, it's a, for GAAP, there's expanded income tax disclosure, and statutory accounting has rejected that. So no additional income tax disclosure for statutory accounting. Next slide. These are very minor, again, just rejections and cleanup of definitions and things like that. Next slide. Okay, this is just effective 1/1, SSAP, this interpretation has adopted an implementation guide for the bond project. So that's what that's all about. And our first poll question. Okay, I guess that was the 30 seconds that Kayla talked about. The answer was true, if anyone's curious. So, all right, now I'm going to hand it over to Ryan Perez. Ryan's going to jump on and talk about the principal-based bond project, which is very important for 25.
Yeah, so thank you, Scott. And the principal-based bond project, it's been out there for a while now, and the effective date is coming up 1/1/2025 for this new bond definition, as well as where we're going to put certain bond instruments within our annual statements. So, you know, with this standard throughout the fall, we've been talking to clients and kind of gauging the impact on many of them. And for most of our clients, this assessment is needed in order to think through the new bond definition and how it defines a bond security, but not a huge impact in terms of moving things out of Schedule D. And I think that was part of the initial concern with the standard was if we were going to see a lot of movement out of Schedule D, because with this new principal-based bond project, they're basically trying to get at, you know, are bonds actually bonds in terms of their structure? Or do they have any kind of equity-like characteristics, like not having a defined maturity, or, you know, highly variable interest that isn't based on something that's debt-like, which would be more akin to a bond? But generally speaking, I think most clients have found that when they review their debt holdings, most of them will meet this new definition, but there might be a few where, based on some of the guidance that we're going to go over, there may be a question as to whether or not it may still be a bond. And with that, you know, I think what we've heard is when you do identify some of these that will likely be probably asset-backed securities, which we'll talk about, a conversation with your investment advisor is really the best way to assess, you know, whether the security may have some characteristics that would require you to move it. Because, you know, knowing the underlying holding and its key characteristics, a lot of times your advisors will be the ones who can kind of help you look at the listed requirements within the guidance and make that determination. So the first slide here, in August, there were some updates to this guidance, similar to kind of what Scott had gone over. I think, of course, with this project being a very big project, there's been a lot of back and forth questions to the SAPWIG, and so they've had to release a series of clarifications and make sure that when we do enter this new period, 1/1/2025, we have a clear definition of what we're looking for. So we do have a few slides here, which I'll touch on quickly, that, basically went over some of these clarifications that happened in the August meeting, which would have been in the summer here in 2024 versus older guidance. So the first couple there just talk about a little bit more clarity on excluded securities, some scope exceptions. Kayla, if we go to the next slide. The next one here, it talks about trying to make sure when we talk about different types of risk factors or credit rating related to credit quality related considerations, we're being consistent and incorporating a decent range of considerations. They also clarified in the summer, they talk about this idea of a nominal interest rate adjustment, which we'll touch on later. They did provide clarity on what that would be. Generally, it's a 10% threshold for the interest rate on the instrument. If you have a variable, return that's greater than 10% of the initial return, it could cause you to look at that a little bit more closely, as well as some additional clarifications. So Kayla, if we go to the next slide, again here, just some more clarifying and making sure the guidance is where it needs to be. Clarifying you need to do this assessment when you acquire the holding. That's kind of the initial one there. And also just making sure it was very clear that this is a January 1 item of 25 and that it's going to be prospective. So, we don't need to go back to prior periods, do any kind of restatement, do any kind of analysis for last year's information or the December 31st, 2024 information. It's a pure prospective adjustment. So Kayla, if we go to the next slide here. So this is kind of the first stage in this new principal-based bond project. They want you to take a look at your holdings and ask if it's a creditor relationship. So they really want to get at, is this a situation where you as an investor are, giving capital to an entity and that entity is taking it and then paying you back at a defined date in the future with an agreed to interest rate, right, to compensate you for giving them that capital. So what they're trying to get at is if there's something with this agreement where there isn't a defined maturity or the principal varies a lot between what you gave them and what you could get back. And, maybe that principal varies based on something like the performance of the collateral on the bond, or it's tied to an equity index or some kind of index that isn't related to debt. It could call into question whether or not you really have a bond or whether you have something that's more like equity. Or if it's not equity, maybe it's an investment, but it might just not be a bond investment. So this flow chart lists a couple of the things that you have to do to kind of decide whether something is a creditor relationship. And that is the first requirement under the standards. So the first one there is, they say, is it a debt security? And in the new guidance, they do list what that means. It's pretty consistent or is consistent with the old guidance. It's a gap-based definition. We won't go into a great deal of detail with that one. But it's basically just saying, is this a instrument or a security? It's not like a direct loan with someone. It's a situation where you have a bond and you're able to see that you can get a share or participation in that in a marketplace. And assuming it's a debt security, which I think most people's instruments would be if they're on Schedule D to start with, the next question is, does it have underlying collateral? And if so, is it equity? And that will require a pretty in-depth analysis if the answer is yes to that. So we're going to move to no and just assume, most of our bonds don't have collateral that's equity. So the next question they want you to go through, or two questions, is does the principal vary? And that would definitely be something that could trigger you not classifying it as a bond. If the principal is not set and you don't know the amount you're going to get back, it may not be indicative of a creditor relationship. Or if the interest varies more than a nominal non-debt variable. And that's the wording they use. And first time I read that, that was very difficult for me to understand initially. But really what it's trying to say there is, is your interest rate or what you're getting on the holding, varying based on something that isn't debt related. So some clarity there that they indicate is this isn't talking about your typical debt or bond-based market variables. So for example, if you have a bond that has an inflation protection and it's a standard inflation protection, that's not what it's trying to get at. Or if you have a scheduled interest rate increase or a step-up rate increase, right? These aren't the nominal non-debt variables that they're talking about. What they would be talking about is if the interest rate is tied to the collateral itself, or let's say the ability of that collateral to earn a return. In those instances where you're kind of varying your interest based on the ability of the collateral to make money or the ability of the entity that the collateral represents to make money, that's where we could talk about, it's not really a debt variable. And then that's where they kick in the nominal. Does it change your return on your bond by more than, let's say, 10%? And I believe 10% is the threshold that they indicate. And then that could be an issue, and you'd conclude that, this really isn't a creditor relationship. Because my return is such that it's really based more on the ability of this entity to generate income, right? Or something like that, or it's tied to an index related to real estate and not the underlying debt or bond. So assuming the answer is yes, it would be not a creditor relationship. But if it's no, and we say, okay, this looks like a standard debt instrument, you just need to ask then, are there any other equity characteristics? And I would think of, just think of a stock. Does it share anything with common stock in the sense of, does it not have a maturity date? Does it only pay, what they're calling interest, if it gets board approval from the underlying collateral entity? So maybe that'd be more like a dividend. Is there something that has an equity kind of characteristic? And if the answer is no, then you conclude, okay, this is a creditor relationship. So going back up to is the underlying collateral equity? If it is, and you do have a bond that has collateral that's equity, it doesn't necessarily mean it's not a creditor relationship, but the new standard says that you have to assume it's kind of not, and then you need to document why you believe it is still a bond, and it very well could be still a bond instrument. But there was some wording that they had that I wanted to mention. So they say the guidance is designed to provide things where you would see the production of cash flows that are predictable and the underlying equity risk has been distributed. So this is what they're talking about if you have a equity collateral. So I think what they're saying there is, do you still expect to have, or can you demonstrate that you're going to have predictable cash flow that would be like a debt instrument? And they list a number of things that you could point to. And Kayla, if we go to the next slide, and keep going, since I guess it just went to the red circle there, go again. Some of these characteristics that you could point to try to say, okay, yes, the collateral is equity, but I do anticipate us getting predictable cash flows. And some of the things here is, the presence of a lot of equity holders within that collateral. So let's say there's a few thousand or 10,000. If there's a lot of entities there, that lends itself to, well, we might be able to expect to get payment versus if there's just a few. Liquidity facilities. So does that instrument have access to liquidity? Can they get their hands on cash if they need to pay you? Over collateralization is a good one. If the equity itself, is over collateralizing, meaning, the collateral's worth 100 million and they're only going to take through this issuance a $50 million amount, you might have over collateralization. So you might be able to support the fact that yes, it's equity, but we feel there's over collateralization present. So there's a couple factors there that you could point to try to conclude it's a creditor relationship. So let's go to the next slide, Kayla. So that's the whole first part of the bond definition is, is it a creditor relationship? I think a lot of securities that we hold are going to meet that criteria. They don't have a lot of equity-like characteristics, or, if there is collateral on equity, hopefully you can point to some of those other factors. But once you've established it's a creditor relationship, we then have to look at if it's an issuer obligation or if it's an asset-backed security. So the new standard says, well, one, you got to prove it's like a creditor relationship, but then you've also got to say, okay, does it fall into one of these two buckets, an issuer obligation or an asset-backed security? So basically with this analysis, when you're looking at this idea of an issuer obligation, and Kayla, you can go to the next slide. This is kind of what I would think of a traditional bond. It's issued by an operating entity, which would just be a business, not-for-profit, a government entity, some kind of entity that produces income and expenses, with the repayment being primarily reliant on their creditworthiness. So, are they a creditworthy organization and they're going to pay us back, based on their ability to make money and the strength of their balance sheet. So, this is really focused on situations where you're going to get your cash flow back just from the entity itself. And when they use the words primarily reliant, I did look at that a little bit, and I think it's an important distinction because there can be collateral on an issuer creditor obligation that secures your bond, but you're not relying on that collateral to pay you back in any way in terms of cash flow from selling it, or just, let's say the collateral was a lease agreement, right, where there are lessees and they're paying based on that. That would be more like an asset-backed security. But the primary reliant idea is we don't anticipate to use the collateral. So they may put collateral on it, but we don't anticipate to use it. And so it could be a issuer credit obligation. So the common examples are, U.S. Treasuries, standard corporate bonds, bonds issued from a couple different sources. We have them listed here. It's your typical, it looks like a bond and feels like a bond. There are a couple of unique categories in here that when you look at the new SSAP, they'll define that can still be presented as a issuer credit obligation. And again, these are going to be on your Schedule D 1.1 moving forward. 1.2 is for asset back, which we'll talk about next. But going to the next slide, Kayla, an example of one of these that they call out as a issuer creditor obligation is a single entity backed obligation. So they say this is a security in which payment is fully supported by an underlying contractual obligation of a single operating entity. And they give some examples. And you can see there that they list certain leaseback securities. And initially you think of that as asset backed, but this is an example of a specific type of security that they say we can still do an ICO for. So with this, they say, if 95%, and that's the specific threshold they use, if 95% of the cash flows basically that are going to be used to pay you back come from a single lessee, in the example of a leaseback cash flow situation, you can classify it as a single entity backed obligation. So when we picture that situation where I'm the insurance company and I choose to invest in this entity that's offering this bond that's backed by some leases, if that entity that's issuing that says, oh, well, by the way, or you can see looking at the instrument, Target Corp or X Corporation is paying 95% or more of the lease that's, funding your bond, you could potentially present it as a single entity backed obligation. Now, if there's 10 or 12 different lessees, then that wouldn't be the case, but it's 95% or more of an individual lessee. So in the example of other leasebacks. So this is an example, I think, of the standard trying to apply a principle-based definition where we're trying to say, okay, what is a bond? And if it's primarily a creditor relationship and it's related to a single entity in this case, perhaps we can call it an ICO, or that's what's most accurate is an issuer creditor obligation. So Kayla, if you go to the next slide, they also call out funds registered under the 1940 Act as being allowed to be an ICO. I won't go into too much detail there, but that is a specific category as well in the new standard that you could potentially do. So going to the next slide, here is just a listing of some of those securities, what we expect to see as issuer obligations on the Schedule D moving forward with regards to what you'll see there. So the next slide, Kayla. So the next part of it is talking about asset-backed securities. And again, I think this is where we see more of the impact. So with the asset-backed securities, you have to go through the flow chart or what they indicate in the standard. You could have financial asset-backed or non-financial asset-backed. And at a very top level, the main thing that defines these two, Kayla, if you go to the next slide, is With a financial asset-backed security, there's no no more performance obligations to generate the cash flow. And we give the example of a mortgage-backed security. In other words, when you buy a mortgage-backed security, everybody's already executed the transactions and the cash flow is expected. You know, no one has to do a further action in order to generate the cash flow for this type of asset-backed security, in the sense that nobody has a performance obligation. If you go to the next slide, Kayla, with the non-financial asset-backed, this is where there would be some form of performance obligation. So common example would be a lease-backed security. And the reason for that is, you know, the entity that you buy the bond from, they have this equipment that they're going to lease to someone. And so in order to generate the cash flow, they have to lease out the equipment. And because there's that obligation to lease the equipment, it's a performance obligation. So that's what would put it in this bucket as a non-financial asset-backed security. And basically with these non-financial asset-backed securities, there's a requirement that they produce what we're going to call meaningful cash flow under this new standard. And basically what that says is it going to produce cash flow over the period that's predictable and debt-like, and it doesn't rely on selling the asset at the end of the period to produce a majority of the cash flow. They define that threshold as 50%. So that's a practical expedient. It doesn't necessarily mean that something doesn't meet that practical expedient and couldn't fall in, but it's kind of used as a threshold. So the example we give here is like an airplane that's, you know, set as part of collateral for your bond. If the entity tells you that, hey, you're going to get all of your principal back at the end of the period when we sell the airplane, that's what we're getting at in terms of meaningful cash flow may not be present throughout the period, because it's almost like you're investing in the airplane versus investing in a bond, and you're really just relying on the sale of that plane at the end of the period. So it might not be appropriate to show that as a bond. On the other hand, you know, if it's a lease situation and the lease is going to produce 50% or more of the cash flow to pay you back over the period, then it is more debt-like. So Kayla, if you go to the next slide, we're just showing the flow chart again. Are we going to have meaningful cash flow? And if you go to the next slide, Kayla, again, this idea, the practical expedient they call out is the 50%. So if it doesn't rely on sale or refinancing to produce 50% or more of the cash flow, then you may have a bond instrument. If it isn't 50%, it doesn't necessarily mean that you can't call it a bond, but you're going to have to do additional analysis to support that based on some of those characteristics we talked about earlier for creditor relationships, like over collateralization or subordination. You have protections, things that would be more indicative of a bond. So Kayla, I think we have the next polling question. It's about that threshold. Okay, so hopefully you got that polling question so you can get your CPE. So going to the next one, the last criteria then for asset-backed is substantive credit enhancement. So this is basically trying to say, you know, is there some form of protection for you when you buy this holding that makes it different than if you bought the underlying asset itself? So we talked about an airplane, right? The credit enhancement, they list a number of things that could be in place to kind of demonstrate that. Kayla, if you go to the next slide. They talk about subordination, over collateralization. So, you know, if you buy into an asset-backed security and it has different levels of investors or tranches, like AAA investors, AA investors, single A investor, and, you know, you buy into a higher level and it protects you from losses. The lower levels have to absorb a certain percentage of the losses before you absorb it. That's an example of subordination. And when we think of things like mortgage-backed securities, if that is present within your buying that individual offering, that's an example of a debt-based characteristic, a subordination type characteristic. Over collateralization, same thing. If you go into a investment and there's collateral that's worth 125%, 140% of what you're giving that entity, so you have a lot of collateral in place, that is indicative of a credit enhancement, so indicative of a bond versus holding the asset directly or having a direct risk, which may not be a bond. It could still be an investment, but it just may not be a bond. So going to the next slide, Kayla, here is where we show on 1.2, how this is going to be laid out. Your agency backed, Fannie Mae, Freddie Mac, that's obviously one where, hey, there's definitely a credit enhancement. The federal government is backing it up fully. So that's clearly going to be, a security that would meet the bond definition. But you could also have other residential mortgage backed or commercial mortgage backed securities that meet that definition. But you'd be looking for meaningful cash flow, or sorry, not meaningful cash flow, because it's a financial asset backed security. There's no performance obligations. But you'd be looking for a credit enhancement. Is there something that protects you, like tranches or over collateralization? You're giving them a certain amount of capital and it's really, really highly collateralized. So going to the next slide, Kayla, for the non-financial asset backed, there'll be new sections. So these are the ones where there is a performance obligation, like a lease-backed security. If it meets the practical expedient and we're not relying on selling that asset at the end of the period or refinancing it, it goes in one section. If we can't meet that practical expedient, it just means that we have to do a little bit more analysis to support the fact that we should carry it as a bond and not a different type of investment. So that's why we're having these two sections. So next slide. Some transitional guidance here on this slide. There's a lot of really good transitional guidance out there. So, if you look up the new bond SSAP effective 1/1/25 on Google, it'll easily come up. There's a good section within the new guidance that talks about transitioning assets if needed, out of Schedule D. So Kayla, go into the last slide here, just a couple quick examples to wrap up this section of the presentation. This is an example of an asset-backed security. There's 10 warehouses and we have lessees, and they're going to use the cash flows from these leases to pay us back for what we're going to give the entity, as an investment. There's a fixed interest rate and there's also cash flow. Now, the key thing with this example is they say that only 10% down there in the lease cash flow is going to be generated throughout the period to pay us back on the principal balance. So that implies that 90% is going to be from the sale or refinancing of those warehouses at the end of the period. Now, the meaningful cash flow requirement, we say 50% is a practical expedient to kind of help us gauge. And as there's less generated from the operations throughout the period, we lean more towards not a bond. So Kayla, if you click, I think it'll say not a bond. In this instance, it's not a bond, and you'd have a really hard time supporting that it is more like a bond than a direct investment in a warehouse if it's so reliant on selling the warehouse at the end of the period to get your cash flow. Now, if we change this and we said 85% or 70% of the principal is going to get repaid back from the leases throughout the period, then we could look at this as an ABS. Another quick example is the typical mortgage-backed securities, right? If the federal government is backing it up, you have a credit enhancement, and so that's going to be a bond. If you have a commercial mortgage-backed security, you'd be looking for if you can see a credit enhancement in that structure. Is there something that protects you, like different tranches of investors or over collateralization? You want to demonstrate that the main risk for you is just not being paid. It's bond risk. It's not that the value of the collateral is going to go up or down, and then that's going to really affect what you can get back on the bond. So Kayla, moving forward, a couple other slides here just describing some categories. And then finally, I think we have our final polling question, which we'll go to here on when the new bond definition is effective, or the third polling question. Okay, and I'm going to turn it over to Scott.
Okay, thanks, Ryan. That was very good. Well, I think because we're sitting at 2:50 now with 10 minutes left, we want to stick to the hour that we committed to. Let's jump. There you go. Kayla's ahead of me. Let's jump to the tax updates. And we're going to skip over the blanks. They're very easy to read, and there's really not much to really discuss with each of those. And then likewise, the exposed SSAPs. So we'll just let you to read, leave that to you to read on your own. And then Matt, we'll kick it to you now.
Great, thanks, Scott. As I'm sure many of you have paid attention to the election back in November, we did want to give you just a brief tax update on some of the tax proposals out there. To give some additional background, and again, I'm sure many of you are aware of this, Trump won the presidential election. The Republicans retained its narrow majority in the House, and then they took over a majority in the Senate. Even with what is perceived to be total control of the executive and legislative branches of the federal government, I would still say it will likely be challenging to make any permanent tax law changes because of the filibuster rules in the Senate. Effectively, to pass legislation in the Senate without going through the budget reconciliation process, you would need a 60-vote supermajority. As of today, the Senate's comprised of 53 Republicans and 47 Democrats or independents that typically caucus with the Democrats. So to pass any legislation through the Senate, they will still likely need to go through the budget reconciliation process unless there is some sort of bipartisan tax bill being passed. When budget reconciliation process is being used to pass legislation, they're unable to increase any deficit in any year beyond the 10-year budget window. So effectively, any tax breaks become temporary. This is also what we saw back in 2017 when the Tax Cuts and Jobs Act was passed, which is why we're seeing some certain business and individual provisions of that bill sunsetting or reverting back to what it was prior to the TCJA being passed. As far as proposals are concerned, the main one that will impact the insurance industry is the corporate tax rate. The Trump tax proposal wants to reduce the corporate tax rate from 21% to 15% for companies making products in the US, and then 20% for all others. For your reference, and if you have any interest in any of the other proposals, I also added these to the slide deck. Most of these relate to individual tax changes, which include making the lower TCJA top marginal rate of 30% permanent, excluding overtime wages, tip income, and Social Security income from taxes, and then increasing the child tax credit to $5,000 per credit. So you can see most of these are going to be tax breaks and not revenue raisers. The main way in which they want to offset some of these tax breaks is through, and I'm sure most of you have heard about this as it's been a hot topic on the news, is to increase tariffs. So the proposal is to impose a 10 to 20% baseline tariff on imports, and then a 60% tariff on imports from China. I think the only other item I wanted to mention, and I haven't really heard much discussion about this, is it will be interesting to see if there's any additional push to reinstate some of the business provisions from the TCJA that have expired. You know, a big example of this that we've seen in the insurance industry is being able to expense research and development costs relating to your software. Again, currently those costs are now being capitalized and amortized under 174. Another item that comes to mind is bonus depreciation being 100% deductible versus what is now 60% deductible for 2024. It's my hope that some of these items will come back to the table, but we'll have to wait and see at this point. And as soon as we hear anything, we will keep everyone informed of any developments. So that's pretty much what we had for a brief tax proposal update. Kayla, you can go to the next slide, which is our final polling question. Our final polling question is, do you believe the Trump tax proposal will be enacted in 2025? This is just a simple yes or no question, and we'll give you some time to answer this. Again, this does bring me back a little bit to 2016, 2017 timeframe when we had our last major tax reform bill. I remember a lot of people thinking nothing would get passed, but when the bill did get passed, or at least proposed, I would say it happened very, very quickly in late 2017. I would say if something does get enacted, I would expect to see something in the next 2 years before the 2026 elections begin. So I believe that is pretty much what we had for our presentation today. I think all we have left is questions. I don't see any questions in the chat.
There are not any questions in the chat at this time. You guys are so thorough that no one has any questions.
Great. All right. Well, that's great. Thanks, Matt. That was really good. Thank you, Ryan. Well, folks, I think that sort of wraps it up. We're early by 4 minutes, but I think you guys will be okay with that. Kayla, that still counts for 1 CPE, even though we're 4 minutes short, right?
It sure does. 50 minutes
All
of the credit hour, so we're good to go.
Excellent, excellent. All right. Well, thank you very much, everybody, and everyone have a happy holidays, and we'll see you all soon, especially if you're clients. So, all right. Bye-bye.